All right, family, this is T. Hope you guys had a good week. Hopefully, you guys are keeping your head above water as the market gets a little bit choppy, to say the least here. So, big week coming up, guys. Election, earnings continue, and it doesn't seem like the coronavirus is disappearing. For you newer traders, if you started trading, call it within the last year or so, you really only know one market direction. Now, it's not your fault, but it's a general statement. All the market's done over the last year or so, especially since we bottomed in March, is moved straight to the upside. So a lot of new traders right now, they don't have much experience in these high volatility environments. So what we want to do this week, guys, heading into what might be a bit of a wild week here for the market, is not focus on the news. Don't approach the market with assumptions of how you think the week should go based on elections, etc. Let's focus on what the market has given us. So in this environment and in any environment, there's really only a couple of things that we want to take into consideration. Then we want to try to ignore the rest the best that we can. So breaking down the market, we're going to focus on 4 different things here, guys. 1, the environment, aka volatility, the current trend, momentum, and then magnets, which is another term I use for key levels of support. So we'll keep it short and sweet, but let's jump in. Plain and simple, guys, volatility, or better yet, what volatility is doing, should dictate everything as far as your trading goes. If volatility is low, certain strategies and certain mindsets are going to thrive, but in these periods of time when volatility is spiking, a lot of that crap goes out the window. So as we approach this week, it's wicked important to keep in mind we are in the environment here where volatility is spiking. So whenever this is happening, guys, buying the dip, getting aggressive to the upside, generally speaking, it just isn't the best idea. It's really tough for the market to make a clean move to the upside as volatility is spiking. So we should head into this week with a really firm rule in place that we want to avoid that temptation to buy the dip and play that quick bounce if the volatility index continues to spike. It's a better mindset to have, guys, that as long as volatility is elevated or continuing to go higher, the market's probably going to be sloppy, at the least more likely ugly to the downside. It is what it is. We can't force what we want on the market. I love doing put credit spreads. I love playing the market long, but you got to trade what the market's giving you. Right now, volatility is spiking, so we have to adjust accordingly. For me, not looking to buy the dip, not looking to do that crap. More so, as long as volatility is elevated and spiking, any bounces that we see, I'm looking to sell somebody a call during that bounce of the call spread. That's my mindset. So that's volatility spiking. Be careful. Just be careful, guys. The second thing we want to focus on here is the trend. So personally, I use the 21 EMA is my gauge for everything. The gauge of the current trend, what kind of strategy should I be looking for? Should I be going long, short, etc.? If you look at the weekly chart, so we're going to start with a big time frame, the SPY is starting to break down underneath the 21. Now, of course, we can bounce next week and everything is cool, but we do want to take into consideration that when we're dropping under the 21 on the weekly, expect one of 2 things. Choppiness, which a lot of people get crushed in, or the potential of a total shift of momentum and a total shift of trend. In other words, guys, the market falling below its 21 EMA on the weekly can kill your current trend. Now, we can pull back here, we can hold up, and we can continue, but breaking down under the 21, especially when you got high volatility, especially when there's signs of bearish momentum everywhere, can really start dragging the market lower. So what I'll be looking for is actually the direction of the moving average itself. If the moving average begins to kind of hook here and curl and turn towards the downside, look out below. We can definitely see some selling pressure. So obviously, guys, the market will do always what it wants to do. We can bounce right back above the moving average and back towards the highs we go, but I think a little bit unlikely. It'll do what it wants to do, but take into consideration that from a big picture perspective, we might be losing the trend here. And now if we go to the daily chart, it's already happening. So one of the biggest rules that we have in the Focus Trades group is that when the market's under the 21 EMA, expect choppiness or expect weakness. Don't expect to get a nice clean bounce and your calls are moving nice and smooth. Expect a shit show, so to say. Now, we can get opportunities, guys, where we get a bit extended to the downside and we can look for quick long positions, quick put credit spreads, buying some calls, playing the reversion back up to the 21, but it's typically not a good idea when volatility is spiking. So that's why we can't just focus on charts. We got to focus on the environment as far as what is volatility doing. That plays a big role right now. Once volatility comes down to earth, there's your potential opportunity to catch that nice snap back to the 21. But as long as it's elevated, as long as it's spiking, not the best idea. So what I'm kind of looking for here, guys, is more momentum to the downside. Now, the market's going to do, I'm going to keep on saying this, the market will do what she wants. I could be dead wrong here, but with volatility spiking, with the trend breaking down, I'm just not looking to get too aggressive to the upside. Rather, I'm selling call credit spreads back above the 21 EMA, looking for more weakness. So volatility is spiking. It's generally not the best for the market as far as, looking for a move to the upside. The trend on the weekly chart might be breaking down. We're definitely starting to break down here on the daily. And now as far, guys, as momentum goes, this is really important as well. So when it comes to momentum, I like to keep things simple. I use a Ttm Squeeze Indicator. So if you look at the histogram, guys, I'm not going to go into a deep lesson on the indicator itself. But as far as the colors go, light blue is bullish. Dark blue means that the bullish momentum is coming to an end. And then red means that the momentum is starting to lean towards the downside. So the energy is leaning south. We're starting to see signs of bearish momentum. So on the big time frames that matter, daily chart not looking too hot right now. We had a lot of fun playing the market to the upside. We had the squeeze, you had the bullish momentum, but it was very short-lived. Once we started kind of dying out here and that move to the upside got exhausted, it was kind of all over for the market. But now things are starting to lean towards the downside. So you got to take everything into consideration. There's a lot of bias right now in the market because buying the dip has been the move all year long after we bottomed out in March. But there's a time and a place to be looking to buy the dip. I don't think it's right now. Volatility is elevated and could easily continue to spike. The trend on the weekly chart and the daily chart is in the process of potentially breaking down. And now you got signs of bearish momentum hitting the market. So now you take those things into consideration, and I know a lot of you guys are chart junkies. What are some key levels of support? I'm keeping it kind of simple. If you look at the daily chart here for the SPY, right around 320, there's your next obvious level of support. So volatility continues to spike. Momentum continues to lead to the downside. I think it at least makes some sense that we do come down here and just potentially test that level of support. Anybody initiating long positions here, anybody reloading those long positions right there, they probably got stops underneath that level. So the market does love to come down and kind of wipe out those limit orders for any of those retail traders, and then you can see the market bounce right back up. But in the face of that bearish momentum that's starting to hit the daily time frame, we could come on down to support and then begin to break lower. So what I would do, guys, is if we get a gap down towards that level on Monday, be a little bit patient. You could get the shakeout, but then focus on volatility. Volatility begins to fade and the market kind of reclaims that level of support and holds up just fine, then maybe it's over for the time being. But if we kind of blow through that level of support there, VIX continues to spike, the momentum continues to look like it's leaning towards the downside, can easily drop lower. So tune out all the election crap, tune out your opinions, your assumptions, what you think the market should do this week, and just take into consideration what the market's giving us. We're in a very high volatility environment. Certain strategies will work, certain strategies will not work at all. The trend is potentially breaking down. That's something we can't ignore. And now you got momentum starting to lean towards the downside, and we do got a big old level of support just below. So I wish you guys the best of luck this week. All things are taken into consideration. I will be active this week, putting up a bunch of different videos of how I'm trying to navigate the market. But I do wish you guys the best of luck. So if you haven't already, go ahead and subscribe. And as far as my open positions, I got an iron condor here on the SPX that expires at the end of this month. So I already closed the call side for max profit as those calls got crushed, and the put side is down there at 3,100. So though we're leaning to the downside, I am still comfortable holding that. And the good news is if the market does plunge, and we do head on down to 3,100, I do got two different sets of call credit spreads open on the NDX. I got to call it safer one up here at the moving average, or above the moving average, right around 11.50.50, or 11.550. And then I got one that's a little bit more aggressive above Friday's high. So that's what I'm looking for this week, guys. I'll keep you all posted. Stay safe. Focus on what the market's giving us. Peace out.